Thank you. Hey folks, we'll get started here in just a couple minutes. I've got the folks from the live room joining us. We decided that we could do better for the entire community if I just went live over here. So we'll get going in just a couple minutes. We already have 100 folks on. Right on, Jack. Hey everyone, I thought I would come live. We were in the live room. Thought we would do the community a lot more good if I were to come over here and just do a YouTube. Just on days like this are pretty treacherous to try to day trade in, especially liquidity is dried up. There's a lot of things going on. So a ton to talk about. So this is the plan. I'm going to be here for 2.5 hours. So we'll do this until probably the close, okay? Yeah, there's nothing good I can tell you, Chris. Some things have already happened that I was anticipating. You could go back probably about 4 weeks ago and you would see that I was talking about this Japanese situation that's going on and the yen declining. We'll go through that in more detail than I did last night. And I think that's one of the critical things to watch. And it's unfortunate, I should have led with the video last night with that. Because this situation with the yen, it's not going to work. My buddy Hugh Hendry had tweeted out an answer to Raw Paul, who was saying that this is like it feels like 2018. This is nothing like 2018, okay? Not even close to 2018. And Hugh made the comment that he thought it would be more like '08, and I said it's worse than '08. It's more, probably I should have said, I just said it's worse than '08. I think this is going to be a potential correction of almost a, I don't know, I won't call it biblical proportion, but it's going to be very big. There is a lot that has to happen in this world. I was talking to somebody this morning. I said, it's sort of like getting caught in a house that's on fire and you can't get to the door from where you are. That's what the Fed is like right now. They can't get there. They can't get out of this. And they're not going to do the things necessary like you saw. I forget who it was. I'm going to it was some small South American country actually raised their rates by 5%. You know, when the whole Russian war situation happened, the central bank of Russia actually did a 5% increase. We need a 5% increase. I do not have all the numbers. I had a really good table last night. I won't be able to. It'll be too distracting to look for it right now. But I have my notes from last night, and one of the things that was very recognizable, looking at history and looking at inflation, is that you have to have the interest rate anywhere from 2 to 3% greater than what the inflation rate is. That would put us at 12% right now. Let's face it, that's not going to happen. The Fed has been politicized for a long time, but it's definitely politicized now. You have a Federal Reserve presidents talking about global warming and climate change, for God's sake. They're not, I mean, they're worried about that kind of stuff. You have a Treasury Secretary who was inept as when she was at the Fed in San Francisco. She was terrible. She actually gets one medal. This is Janet Yellen. She gets one medal. She didn't have any catastrophes happen during her tenure as Fed chair. And she was the only one. You can go all the way back. Paul Volcker was self-induced, but Greenspan, you can go right to Bernanke and then Yellen and then Powell. So she was the only one to get away with it, but she didn't really do anything. And fortunately, the QE that was in place from Bernanke was just being continued, and everything was reasonably stable. I mean, everything got jacked up when COVID happened, and they shut the economy down, and you went from busting the not only supply chain, but the market's demand went to zero, right? And then it came back with a vengeance. They pumped in trillions of dollars, and now we have overcapacity and demand off the planet. You look at some of the GDP charts and things that how we swung the other way. It's huge numbers. So we've just got a lot to deal with here. So I'm going to try to unpack, go through like I used to do in my old streams, and talk a little bit more about what is happening here on a bigger scheme. And we're looking at S&P right now down 125 handles, 37.75. Some folks were hoping for a 38.09 bounce and double bottoms, not in the cards. There's no reason for it to be in the cards. And so the markets are just seeing this massive acceleration. So let's talk about a little bit more. I'm going to go back to my comments I made to Hugh and Raw Paul, right? Is that not only is it worse than '08, it's worse than 1987. And I got to be not a keynote speaker, but I was a speaker in Mexico City, and it was early November 1987. I spoke at the International Conference of Chamber of Commerce in Mexico City, and I was to go up and talk about the markets. And I remember how I started off that speech. I said, I checked my calendar. It is not 1929, it is 1987, and let me tell you why the market's not going to collapse any further than it already has. But I'm going to tell you now, it's 2022, and I'm going to tell you that this is long from over. We may get a bounce somewhere in here, but nothing matters. Somebody was saying something about my 45-30 number. It's just a number. I know the probabilities now are, probably 9 times out of 10, we're going to close well under that number. So I know I'm going to get confirmation as we come into the month of June. That would be an unbelievable rally to get back there. That'd be 800 S&P points. Not going to happen. But my point of what I'm trying to get here is that every time we have a collapse in prices, they're similar in the numbers, the percentages, and things of that sort. Obviously, the details behind them are different. And this one, has never been, I kind of chime in with Jamie Dimon and what he's talking about. We've never seen anything like this. No one likes to say that, but it's true. We've never seen, we saw QE that was crazy, and now we haven't even started the QT yet. We haven't even started it. And these are the type of action you're seeing in the market. So I'm going to try to tie this together the best I can. I usually don't get a chance to do this very well when it comes into the nightly videos. I try to keep it fairly brief, but I'm going to try to just talk a little bit more about some of these things that are going on. So you're seeing, I'm still trying to get tie together this thing with Russel and Hugh Hendry, is that the reason why it's way different than 1987. 87 was just a snafu to program trading, and there was just a big giant drop. It supposedly was over, a trade report that came out. It wasn't about that. That report wasn't necessarily the trigger, but it was that was what happened around that time. It's like people try to find the event that happened. It really was about trading. Computerized trading had just begun. I know there's a guy that's been that bought the indicators. He was working for a firm. I'm just seeing if he's around. A lot of times he is. I don't see him right now. But he would work with one of the firms there in 87 that was involved in the program trading. So 87 wasn't a financial crisis. It was just a market crisis. It was literally due to trading activity that had never happened before. And, and there's been a lot of changes in the market since then. We had decimalization. We went from that to now to fractional trading. And it's gotten even much crazier, much more convoluted than it was before. So right now where we sit with, let me just bring up something here on my other monitor just to bring it up. I haven't looked at this for a while, but I'm bringing up the U.S. debt clock. I'll put that on the screen here. So we're looking at the U.S. debt clock right now, 30,513,400,000,000 blah blah blah. Right? Whoever thought? I've been saying for years, and I have some documentation on our VPNpartners.com website that you can't get unless you're behind a firewall, but an article, annual report that I wrote in 2020. I'm just going to put up another chart here so we'll have some entertainment here. I lost my train of thought. We're really, the whole idea and the concept here is, this is what I was saying in 2018. I was talking about, what number was it? We were at 18 trillion, maybe 16 trillion at the time. So what number is it? Is it 20 trillion, 22, 24? Well, it turns out we're finding out what the debt ceiling is. And this is what I said to Hugh and Russel, is that we knew a long time ago. Hugh and I've talked about this over the last decade off and on, is that what is that you couldn't solve a debt issue with more debt. And now we've got it. So everybody wanted to be, I guess, like Japan, from the standpoint that they did QE for 30 plus years, right? And supposedly it was working, and everybody thought, well, we can do that too. In the end, everybody ends up like Zimbabwe. You get hyperinflation, and it just gets worse and worse. So where we are right now, 30 trillion in debt, we're looking at just everything that's out there. Consumer debt has spiked. I think that's had a lot to do with inflation and costs. All of a sudden, everybody's starting to get pretty stretched out. So the next thing is demand destruction. And I believe, and I've been saying this on the channel here, as well as in our private room, that we're already in a recession. You just don't know it yet. Whether the numbers still positive in this next report or not is not really relevant. But we're seeing everything coming to a screeching halt. Those of you who hang around my channel, you know I've been talking about the whole concept that we were going to get, hit a wall on the economy. This started in fourth quarter of last year. I continue to talk about it, and the numbers keep coming out good. Employment numbers and are really good. And now we're finally starting to see housing. We're starting to see some other things start to crack a bit. And so now is going to be where we're going to start to see more visibility, ultimately earnings destruction, all of that stuff's going to happen. So how much of that is priced in? Probably a fair amount at the moment, but there's much more. And I'll go through some in-depth details on a long-term viewpoint. I'm going to do that here today. I'm going to take the time to do it. I've got plenty of time. I've only been going for about 16, 17 minutes. So I'm just getting warmed up here on this whole thing. But the whole point of this is that this is not 2018. It's not 2000, the dot-com bust. It's even worse than all of these. It's worse than 87, and mainly because of all the debt buildup and the unwind. So we've never seen QE get as big as it did. Now we have to try to burn off this. And they're talking about, just a runoff, right? And accelerate the runoff, okay, that's fine. But you could almost take every mortgage that's paying down and just let it all pay down, and it wouldn't be enough. And this is the problem with what's going on with the Fed right now, and why my analogy is that they're in a burning house, but the door is across the way and there's too much fire. They can't get there, and there's no windows behind them. There's no way. And I made a comment on a tweet just a few hours ago that the Fed is not driving this bus. They have no control over what the BOJ is going to do with these treasuries. How much are they going to do to support the yen? That's the real question here. And at some stage, they have to be careful how they sell the treasuries. I mean, look at this spike already today. My guess is they showed up as the seller. And who knows? You get China going, hey, let's just sell some treasuries too. This would be the biggest war against America ever, as you can crush them through their debt. As those two entities between China and Japan could sell enough securities to ruin this country. It'd be that simple. And if they don't really, Japan's just trying to save their own ass. And China, they probably don't even care. So they might just do it just to be doing it, right? So then they will be in control, and they can accelerate their path to be the largest economy on the planet. So I think there's some things that is going on that are so big here, folks, that this is not going away. You look at what's going on in crypto, crypto's got a hold here. I haven't looked at where it's at, but it's got a hold where Bitcoin has to hold 22,008, or it's heading probably 8,000. It's a complete debacle. And so I'm just going to continue on a little bit of a rant about this stuff, but I think the most important thing to watch is the Japanese yen. If it prints over 137, then we're going 142 plus, and at that level, it's just outright ugly. I don't think that I've been around long enough. You go back to 99, you can even go back even further, where some of the Asian crisis and some of these other things that happen. Once these things start to roll, they don't stop very easily. And this is a very, very big event that's going on, and it's the world's biggest event ever. As the world ever, you can go down a list of anything financial, I guess just about anything, population, debt, everything, and all you're going to see is records, the history. And that's part of mankind, right? You go down the timeline, and things get bigger and grow, and there hasn't been any contraction, anything that looks like 1929. So the comparison to 1929 might be this, is that we get into a multi-year correction where I just saw something really interesting. Everybody, I like to watch a halftime report just to figure out what's not going to happen. And these guys, these jokers on there, have a bunch of investment advisors, probably none of my customers, but like some of my customers on that side. And they're talking about, one guy was saying, well, just take your best stock and buy something here so you can say you participated. Like, what? Anyway, but they have really stupid concepts and ideas. And no one just looks at like, hey, just get out of the way, because they don't believe in that, because you might get out and you might have taxes. I always say I'd rather pay taxes than lose 30% of my money. I'd rather pay taxes on profits than lose 30% of our money. I went through a bunch of our accounts today, and I'm looking at our average losses on the year are around between 6 and 8% on a lot of the strategies that are out there. And we have one strategy which has been out since December 17th, has been in cash. It's flat on the year because it hasn't owned anything all year. And it's still, unfortunately, it doesn't look like it's going to own anything. So anyway, you see the market's kind of rallying a little bit here as we're talking. But I just want to unpack a couple things here. So most important thing, watch the yen, watch for 137. 134 was a trigger. We went over 32 last week when I was out of town, and now we printed 34. We saw them sell. We saw them come in to defend the yen, and I think ultimately it's not going to work because they're going to be limited to how much you're going to sell. And I think the scariest part is the Chinese connection. Is if they decide to sell some debt, now they can push yields well over 4%. Maybe that sounds like crazy talk, but I've talked about this before, that the market right now is being led by the Fed, is being led by the market, not the other way. So the Fed had the luxury of being having the tail wag the dog. Now the dog is wagging the tail, which is the markets are leading the direction. They have virtually no choice but to adjust 75 basis points. But like I said, if we look back at history, we need to be at 12% to fight inflation. They're not going there, right? That's not going to happen. No way that's going to happen, right? So they're going to do 75 bips. Maybe they announce that they end up maybe accelerating the runoff a little bit. But like I said, they could just let the whole portfolio run off and it wouldn't matter. I mean, it just wouldn't matter. And that's the other thing, is that the Fed owns something like 30 or 40% of all the mortgages in this country is owned by the Fed. So they're no longer buying. So what's going to happen to the mortgage market? There's so many cracks in the system right now that there's literally just about anything that could break it. But I'm still sticking with the Japanese and the Treasury market, with the Chinese and the Japanese absolutely being in control of the destiny. The Fed has no control at all. There's nothing they could do. They could come in and try to buy everything that they're selling, and then that would just be viewed as more inflationary type position. So nothing's going to happen other than they're going to do their 75 bips because they don't want to scare the market. Well, market's already scared. I mean, you're looking at right now about 9% down on the S&P since last week. I think last Tuesday. So anyway, those are some of the opening comment things that I wanted to bring out again. And I just let's take I'm going to go over to another page here, and we'll just look at Bitcoin 23. So this is interesting because the low was 22.6, and that was the number I talked about last night. Let me go to the weekly chart here real quick because I believe we went right to, 200 was 22.361, low 22.610. It had to bounce there. We are getting a little bit of a bounce on that pattern, and it's interesting because Bitcoin, while it's looking like I'm going to bring up the Nasdaq here because we know the correlation here. Let me go full screen so you can see this a little better. So you can see the pattern unfolding. We go to, so we're looking at 22.6. If it goes down there, there's a number down here at 9,840 is a pivot that's been marked down here at that level. So if we got through this level, then we're looking at another 50% plus drop in crypto here. So this is the last stand. So let's do this and go, and we'll put the Nasdaq futures up here. And so we're not quite to the 200 here. We've got a little bit more to go. That's at 10,830. So another 500 points. Let me make sure I get that number right. 10,813. So another 600 points from where we are now, a little bit more to get to that level. But I do believe that we're looking at a test of that, and the Fibonacci's that I talked about these last night. I believe 10,164 is Fibonacci target 2. We've already printed through Fib target 1, and then the low target is right now on the Nasdaq is 9,288. That's a big number down here. I'm going to convert this. It looks like I'm stuck here on the Nasdaq here, but we're sitting here on the 200-month moving average as well. But look at the PPMs here, folks. Those of you who've been watching the channel for a while, this are ugly. 2.78. We're about to roll over negative on the PPM2 is still flat, 0.02. Once we get down below there, and what the best thing that could happen in this market is we get sandwiched between the 40 and the 21 period moving average. And that would be probably the most encouraging pattern that could emerge from here. We get some stability, get the so-called summer chop, get the summertime blues where the markets get really slow. I don't think we have to worry about that this year. I think you could take all the seasonal, all that stuff and throw it out. Although right now, sell in May and go away is actually working pretty good. That was a good cliche, but the answer really was sell in January and go away. And that was the best answer. And, our database is at 10% long right now. I can bring that up pretty quick here. Yeah, we're 10.35% long on our database. So only 1,674 symbols long out of 16,171. So virtually no trends whatsoever. I'm just going to keep going off on this stuff, and then we'll get into some technicals here in a few minutes. Okay, so I'm going to bring up. I'm going to bring up our portfolio expert. I'll slide it onto the screen here. I was showing the folks in the room. So this is our portfolio expert software. And the reason why I'm showing you this is we did a hack on XLEs, and right now we took and basically cherry picked all the best stocks. There's about 25 of them. We put them in here. Last week, this was down 1.7%. We had we had 2 orders today coming in, and I'll show you a couple things. But this is, if we just go to year to date, you can see it's come off here. There's a mountain graph here. We built this in January, okay, because I believe that there was going to be another run in the energy, and we did get that run. And so from there, year to date, we're up 39.39%, still as of on Friday. So today, I suspect we'll see some more selling. Right now, we're still 83% in cash. Let me bring these. I won't bring them up on screen. I'll just read them off here. Current right now is 83.53% invested in these stocks yet, only 16 in cash. So we have right now total active 42 symbols. We only have 32 of the 42 long right now. And we look at the monthly returns on this strategy, and you can see 2020, 8%, 42% last year, 39% this year. So just in the last 2 years, this has been pretty phenomenal. But I show you this because this is the only sector that was working, right? So we'll come back to Wavetech here. And Wavetech shows you here that the energy sector has been long since November 30th. We know that's the one that is working and has been working. But it's now starting to show some cracks, and this is why what's happening here. What's happening here is all stocks are being sold, right? And so it's called raise money, and that's what's going on from this standpoint right now. It's just raising capital. If it's a stock, then let's sell it and take a look and see what's going on. And, I think, those of you that are institutional types where you're individual money managers or advisor types, this market's not over yet. So I know a lot of people stuck their head in the sand and hoping it's going to get better. You're going to have a lot of babysitting to do. And it's not going to be very pretty, because if the 10-year does spike on this Japanese situation, this market goes down a whole nother level. Because what's going to happen then is money's not going to be free like it has been. Earnings are going to get impacted. Forward-looking, everything is going to be impacted. And last night, I won't go off on this because I did last night, but this DEF situation with diesel fuel and shortages, there could be a whole nother supply chain issue that can come up, and you can't blame it on China, the boats, or anybody. It's if you can't get fuel in these trucks, it's going to be a problem. There's even issues with ethanol. And so this, not a pretty picture, folks. In times like this, I'm even the best guy to know, or the worst if you don't want to hear this stuff. Yeah, but this is a pretty dire situation. Not saying we maybe we get a bounce here, but this is something that is going to be going on for a while. This isn't going to be done in, start in January and it's over in June. And that's the other thing that triggered me that I wanted to talk to you about, is that in this halftime show today, everybody and all the analysts, 50-50 chance of recession. I think we're already in it, but this was the big number. Well, if we do go in recession, it's only going to be mild. It won't be anything. It won't be, elongated. It won't be a long one. It'll just be very short and it'll be over. That we're so used to thinking like that's the consensus right now. So let's just review this for a minute. The inflation was transitory, then it wasn't. Then it was going to last longer, and then we had the peak, and then it wasn't. Now we're going to have a recession, 50-50 chance, and if we do end up in a recession, and don't worry, it's going to be a short one until it isn't, right? So one of the things, I'm going to go to some long-term analysis here, and And yeah, Sergey, I said that earlier. The sell in May and go away. It was actually sell in January and go away this year. So anyway, let's do some long-term analysis. Let's get into some technicals. Let me just see what some of you folks are saying. The inverses like the TQs I call them and the SQs. They get really distorted. Just so you know, let's talk about those inverses for a minute. Let me just see if I can bring something up here. And I'll bring it on screen here if I can. Okay, yeah, let's talk inverses for a minute. I think we should do that. That would be a good thing. Let me come over here, put this on screen. Yeah, so I've got the SQs up here. Obviously, they're looking pretty good. There was actually fib targets. There was a cycle low on the 6-8 that was signaled. Those you have the indicators. This is the fib projections. Was projecting for this to come up to minimum 43, 58, 63. We're trading right now 63. So all of those projections, this is a daily chart, came out on the 8th. But I want you to look at this chart real quick. I'm going to leave it small. I'll blow it up. Let's blow it up here. Exactly. SQ is the inverse and TQ is the 3 times bull. Exactly. So, but let's just talk inverses or leveraged in general here. If you look at the way that these things trade, especially like the inverses, they tend to get to a certain point, and what happens, there are very high fees embedded in them, but they also rebalance. I believe it's every 3 days. They were meant for short-term holding, and I have seen some of these inverses blow up. There was one that was on an inverse on a bond, a short bond that Barclays ran, and the thing blew up and went to zero, and they had to liquidate it. So if too much movement happens too quick on some of these, they may have trouble rebalancing, and they have been known to blow up and lock out. So some of these ETF strategies are very, very treacherous, and because you can get caught in them. And I'm going to see if I can find something. I know that we had a strategy that we had in our pre-built strategies in our portfolio expert, and I think also in Wavetech, but it just had the inverse. So it had like I think a 3 times long and a 3 times short, and it just traded, bought and sold those, and it's done pretty well over the years. I'll have to see if I can find it efficiently so I don't have to have you folks sitting here in silence. But these inverses, if you catch them early on, like right now, this is not a good time to be looking at inverses. Even, the market may continue to go down, but when they reverse, they're going to just take all the oxygen out of the room all at once. So try to find points down to buy, like on last week on the 6-8 where that cycle was. If you had the PPMs, you can see PPMs were giving buy signals back on the 8th as well. So, and they're still in a bullish mode. And we may go up 67 as the high fib target, and maybe we get a big swing, but you're going to have to be, when you see the prices go. And I saw a comment, so since we're just talking a little bit about trading and using inverses or trading these leverage deals, I saw somebody say, gee, I wish I had kept my puts a little longer. So I'll go into this rant here because this will be relevant. And this has things that we talk about in the live room, but this is something, as I always suggest, if you can, I don't care if all you can own is 3 contracts, fractional shares, whatever, you should have a strategy. It's basically a 3-pronged approach where you put on a trade, you set up what your risk is. As soon as the trade starts to move to a minimum target, you take 1/3 of the position off, and then you have a price target that you're going for. So the goals are this: you take a third off, and then once you take that third off, you can usually raise your stop up possibly, depending on how much it moved on that first third, to a break-even stop. So now you can't lose on the trade. And then you would sell the second tranche, and if it was puts or calls or just outright ownership of futures, stock, whatever, you would sell that on a target price. You would sell the next portion, and the last third, you just raise this thing. Typically what you do is you'll raise so that you put a stop underneath the market so you can't lose at all, but you trade out that last piece because there's no way you can lose. And so I always say, if you can get to where you're invincible, meaning that you can't lose on a trade, you can then play out that last piece. So you should have kept a little piece of those puts instead of just running and taking them out. And if you do those kind of layered trades like that, and especially if you can do them in threes, you can execute. First plan is to eliminate risk on the trade. Second plan is to have a profit target that's hit. Third plan is, as long as the trend is in place and you're looking at trends and what's going on, you hold that until that next level. So with the inverses, you might get to go to that third level, but for most of the time, you're just looking at a target. And since you're leveraged 3-to-1, especially on like SQs or the triple bulls, and when you're leveraged at that level, you have to realize whenever you hit that first target, you've already made close to probably 2.5 plus times what you would have made if you'd have just owned SPY or been short SPY, just a single, right? No leverage. So you need to just learn to take those profits, stair step in and out of trades, and remember they're just trades. Okay, lesson for the day. Okay. And that's the reason why I was hesitant and tell you to be careful with these, because that really you just have to be really careful with those. Yeah, Antonio, I'm looking at your comment. Bob is worse, ? In what way? I'm telling you, don't buy them. So, listen, Harry Dent has been saying short forever. Peter Schiff, he's not even, look at his funds. If you want to see what Peter Schiff's value is, look at his funds. I have no idea how the guy stays alive. Guess selling gold to people. But that is, yeah, so you just need to be really, buy low, sell high, especially on these inverses. You got to buy them right. You can't chase them. If you chase them, you just get in trouble every time. And that's what happens with a lot of strategies, is you end up, if you're chasing something and you chase something that's 3 times up or down, it's a problem. So you've got to really think that. But yeah, so all right. So let's see where we go from here. I'm just looking at some of your comments. Okay, Antonio, no problem. Yeah, I had the misfortune of meeting Peter Schiff once. That was interesting. I'll be nice, even though he wasn't. Yeah, so the Fed doesn't have any control over how high the rates go. So that's a misconception that we're talking about here. So let's go into that for a minute, and because I think once the bond vigilantes, if China and Japan can completely destroy this country right now, and I think Japan would be just selling treasuries for their own well-being, because their debt doesn't come close to yielding what ours does. So they bought I think 1.3 or 1.4 trillion US dollar value of treasuries. So, and I suspect they're probably buying in the 5 and 10 year level. So when you start to look at that, that's pretty important here. Yeah, so I just brought up the yield curve. I'll just leave them up here because the yield curve is inverted again. And I talked a little bit about that. So the yield curve is collapsing once again. So this is just everybody's, that's where, so you can see, I like the 530. I don't like the whole scenario around the 2 year. It's too retail minded for me. When I worked with the banks, the 530 was the important one, but we're almost down to the April lows right now. April lows was at 12.5. We're pushing 9.4 basis inverted. And this will be the key on this inversion this time, that we stay there for at least 3 or 4 weeks. That happens, then that tells us the recession is going to come out in a further distance. So I know this is just kind of a random go around with what I'm talking about here today, but I really want to, we'll take a look real quick, and I touched on this last night, but I believe we're about to enter a 4 to 6 quarter decline, and the magnitude is very difficult right now to nail down from that viewpoint. So we're going to have to see exactly what's going on there. So bear with me just 1 second here. All right, had to turn the air down. Arizona, what can I say? Even up here in the mountains, it was 100 up here yesterday, which is a lot up here. Okay, so I just saw that Jay's here. Hey, Jay. Yeah, so somebody was just saying, do I really think I don't think I don't think any, I don't, will Bitcoin hit 9,000? Could it? Absolutely. Let me just, I'm just spinning through a couple things here. Let me get back over here and get to this page. Bitcoin it's 23,477, so it's bounced just about 1,000 here. So and it should have bounced at that 200. I guess if it closes under 22,000, then yes, 9,000 is definitely going to be it. I had something I wanted to do. We're going to go through something here. We're so down. We're not really getting much. There's a little bit. Let's go over here. Got a little bit of a bounce, but we're right back, pressing back toward the lows. I think the low was what, 50.49. So we're starting to see a little bit of a decline again going on here. All right, let's talk long term here for a few minutes on S&P. Yeah, I don't think there's any sweet talking to go on. So let's take a look at this. This chart is a 3-month or a quarterly chart, and this is a big deal. PPM's all collapsing here. You guys should all have those. The link's on the top of this page. But the collapse underneath the 10-quarter moving average, this is super long term. I'm going to scroll out here. Everything that's on this page here right now goes back to January of 1871. And this was the depths. I don't know how many of you are historians, market historians, or economy, but this was one of the big decline from 70, around 77. Markets started a recovery around here in 80, but this whole cycle here from 80 all the way to 96, this is 1796, okay? I'm sorry, 1896, I said 17. 18, that almost 20 years there. In the UK, it was devastating. In Europe, it was even worse. This was just stagnant for years. This was the big railroad bust that happened. You know, if you haven't researched that, go back to that. This would be a collapse of after Louisiana Purchase, all this kind of stuff. There's some major history there to study, and there have been periods of time, and I realized to compare the late 1800s to today is not appropriate, but what is appropriate is that we've never seen anything like this. Now, I started in 1979. We came out of the lows, went into the bull market, and you could argue that we've been in a 40-year bull market my entire career. Been a couple of blips, but we've never seen any huge flat periods or any prolonged corrective type activities. So let's just talk about this, because I think this is something that people underestimate where we are in history right now, that we are at this climactic type scenario. You think about, I'm not going to make any comments other than this, take a hard look at society. Okay? So I can tell you, I was in Uvalde, Texas in the last week. Was in the region. I was there. My wife's from there. Okay, we know we've been impacted, not directly, but indirectly in the community there. I've been going there for 20 years. But look at what's going on in society, how it's broken everywhere. I'm not going to go into any depths of anything other than that, but everything's broken. Everything's, it's like Rome. It's like the end of Rome, right? How everything got really crazy. So we're definitely at a societal peak of some sort of maybe craziness and all that. Financially, everything is there. So to go through some kind of austerity multiple years is not unrealistic. I know we've all gotten used to it. Listen, I'll be 70 here in a few weeks. And I've been around markets for 40 years, since I was 28 years old. So it's actually be working on 43 years. And, we're kind of used to buy the dip. But when this thing rolls over this time, it might be something much, much bigger. And it will most likely last longer. So I'm going to go into camp early on and tell you folks, that not only won't, if not if we come into recession, that it won't be short-lived, that it's going to be much longer than anyone can imagine, and it's going to take a lot to correct this mess that's been created. So I kind of looping all over the place, but I'm going to go back and talk about a thought that I was talking about earlier with the Japan situation. So the Bank of Japan made the decision 30 some years ago basically to do QE, keep interest rates low forever, and they were going to manage themselves way through it. And I said to Hugh Hendry, I said, well, we now know what the BOJ experiment, it is now ending. I believe it's ending, and we found out it didn't work. Now they've got to unwind their QE. They're trying to get out of it. And they've transferred their QE and used our securities. And so now this whole globalization thing is starting to become even more detrimental than beneficial than what it was promoted to be. So, and I'm not so sure that it's not, I won't go into conspiracy theory, but I'm not so sure that this isn't a collapse, isn't what they want to have the opportunity to rebuild, right, in their own way, whether it's WEF stuff or whatever you want to go with. I'm just saying that those things are out there, okay? So when I look at a chart like this, you can see it from the 20, this was right now, this should be 1932 lows where I have my cursor right now. This is the 32 lows, and you can see going through, this is World War II. World War II is over here, 44, 45, we start to go up. You know, my entire life, I was born in 1952, so this was the beginning of this long bull market. We had a couple corrections, but we just have been climbing literally. You know, you could argue for, instead of 40 years, you could argue that the bottom here going all the way back to 32 to current, almost 90 years. And this is why everybody that you see and you talk to have the following beliefs that have been built in. Well, you know, market just goes up X amount of percent every year. And that's been the case since 1952. There's a couple corrections. I was looking at some charts this morning, GDP, some other things going back, I think to, didn't go to 29, I think 55 or something I was looking at. And you see the recessions are the little slivers of grayed out areas. So recession's been really, really short, all those things. And that's typical. You know, maybe what I'm talking about right now is a declining market for after June's close for at least 4 to 6 quarters, so a year and a half. At somewhere in between that point and getting to that year and a half, we're going to find out if there's not much more. And the thing we don't know is there a panic somewhere in there that causes prices to correct more? And I keep telling everybody that a lot of these, all the growth stocks, the Cathie Wood stocks, all of those, many of those are A, going out of business, B, will never see their old highs ever again. And I know they're innovative companies, but that's not going to matter. There might be someone else to do that. I mean, remember AOL? So I could tell you a story about AOL that happened in 99. That was a crazy story. But the point is that we've never seen this long-term, even flat period or correctional period. And are we going to have to go through some kind of austerity to be able to pay down this debt and get rid of it? What is it going to take? Is it just going to be everybody, oh, well, the Fed's going to do a runoff and everything's going to be okay and we'll go back to normal? No, I think this is potentially a major turning point in history. And whether it's started by, you know, who knows, whether the scary part about having a war going on, we haven't even touched on that, is having that going on is if it escalates, which it appears to me just about everybody in the world is really trying to do just that, where it's escalating into the best way to put it, it's escalating to a point of a tipping point right now. It wouldn't take much to take it over the edge. And now throw a world war in there and of large magnitude, and you see this chart drain down from more. You think about 3 or 4 years of a major war, and we live in a different time than we did in World War II. My dad was a World War II vet, and that was a much different time. He told me stories about things that happened. It wouldn't be anything like that now. You got drone wars, you got, God help us all if there was a nuclear war. But these are things that is going to affect market sentiment. So there's so much you could throw at this market right now to be negative. It would be really simple. I'm actually not saying that that's necessarily the thing that is going to happen. I'm not predicting that. What I'm saying is there are so much. We're not even talking headwinds. And I like Jamie Dimon's hurricane comments, but I like them at another level. I like them at that those are the headwinds. You're trying to fly into a hurricane and trying to make progress there. And I think a lot of things are going to be disruptive. I don't know how crazy it gets. You've got a lot of ideology in this planet right now trying to push us toward solar panels and all that kind of stuff, and that's fine. I mean, but the reality is that doesn't happen overnight, and there's just way too much, folks. It's too much. Yeah, and I just saw David Ford just said China, Taiwan is way bigger. Absolutely. What do you think we'll do with that? Nothing. Yeah, and I agree. I got a bit of prepper in me. They no longer look crazy. That is absolutely. So, yeah. So, but this long-term situation, this chart that I have up here, this is going to be dominating my thoughts going forward for probably the next year and a half. We're going to get a confirmation. Remember how this started, folks? I'm going to bring something up here. We're going to go to a monthly chart. See if I can blow this up so you can see it. This was January, where I have the cursor right now. That was January. So we got an outside reversal. If you remember my dialogue, and if you go back and watch late January, probably the last week of January videos on the channel, I was talking about this outside reversal, technical outside reversal. And if we got a lower close the following month, it would confirm the reversal. And then we should get at least 3 to 5 months down. Well, we're there now. And we're coming down toward the monthly 40 period moving average. So we've satisfied that, but this is what was the setup that I talked to everybody about. Was we have a monthly reversal. It got confirmed at the end of the quarter, the first quarter. We'd have an outside reversal on a quarterly basis. The second quarter, which we're about to do right now, a lower close, will confirm a outside quarter, which tells us 3 to 5 more potential quarters of lower prices. And the question then is, how low is low? And I hope if we got to the monthly, the 200-month moving average is actually 2148. That would be a crazy number to get to. But there are some really big numbers out there, and this is a monthly chart we're looking at, and this is actually going to lead us to some substantial substantial declines, I think. Yeah, what's the comment of the WEF? You'll own nothing and you'll love it? Something like that, right? Yeah, I'm going to proclaim already that we're already in a secular bear market. It's just going to last for another year and a half. It could be 3-4 years. Could be a monster correction. I mean, we've got just corrupt politicians and companies, and it's terrible, folks. And you know, I'm a boomer, right? So I would tell you that the baby boomers, I've said this before, are the worst generation. So my dad's generation was the greatest generation and fought World War II, is how they've been coined. I coin us as the worst generation ever. And for the most part, millennials are our children. And I'm sorry, the Gen X's are our children. And the millennials are our grandchildren and some of the Zoomers. So when you start to look at the breakdown of society, you know, that's all this stuff happens. So we raise the Gen X's that raise the millennials that are now bringing in some of the Zoomers. They're a combination of millennials and Zoomers. So yeah. So I just think I think I sunk my putt finally. I'm happy I got to unload all that for about an hour, so I feel much better about that. But these are really very long-term trends, and let's see if I can get to. Let me just see if I can get something. I'm just trying to get, let's go over one of the things I want to look at real quick here is go to the monthly. I was hoping to get, so we're getting up at the upper end of the expectations for the month on the market grid. Yeah, Steve, 52 here. So absolutely. Couldn't agree more. So yeah, just looking at some of your comments here. Yeah, Leo, I'm not sure about you having plenty of time. So that goes along what I'm talking about here, just looking at some comments here, is that's what people think, well, hey, I've got 30 years, so I got plenty of time. Time is not always on your side, depends on what you own. I'm just saying we've never seen a contraction or this kind of debt levels. If we have to, I know Dalio talks a lot about this 100-year debt cycle. I'm not studied that, but I'm telling you that it's pretty obvious that we're at some major point in time. That seems to be pretty obvious. And whether it's this print or the last one, I can tell you in, I think it was 2018, I'm going to bring up on the other screen here. I'll just talk about this while seeing if I could bring this up real quick here. Bear with me just 1 second. I'm going to bring something up, I believe. Yeah, I'm going to bring up a couple things. I kind of miss doing this stuff, but this was a 2016 outlook that I did, and was talking about, I was reading this the other day. It's interesting. I miss writing this stuff, actually. As pain in the ass it was to write this, I miss writing it. So, but Uncharted Territory was that 2016 outlook, and we're talking about excesses, bubbles, and demographics. Well, demographics are coming into play as well, because one of the things that is interesting to look at, I remember back in the day when I was in my mid-30s, so those of you that are in that range, that we were being groomed, those of us in that age group around there, under 40s, above 32, were being groomed to be the next executives and people running operations. So and when I was 37, I was at a brokerage firm called Stoutler & Company. I ran the third largest division. Everything was wonderful. I was a head of a financial analyst there. All that stuff was good. And, and the company blew up. Okay, so all of us ended on the street. 5,000 people lost their job in 2 weeks in time. But the point of me bringing that up is you start to realize when you're at that age, you start to look at all the executives 55 and older are now looking for the door and retirement and those type of things, and the next group is going to roll in. So it's up to pretty much the late millennials are going, you're in that position right now to roll up. So demographics are going to change. Ideology of how the market reacts and responds to things are going to change. I mean, the boomers have been responsible for just about every atrocity that you can imagine. I won't go through them, but this demographic change. So the millennials, for the most part, you folks are, if I'm talking to you, are the ones that are going to have to fix all this shit. And there's no way around it. So, but this was kind of interesting. I bring up this graphic. Let me go full screen. This graphic that this is a great graphic even for today, right? Federal Reserve, look, they're trying to put the cork in it. Well, they pulled the cork out and they just let it flow, right? And so everybody let it run. And I think here, if I scroll down, yeah. See, I was thinking we had the top way back when, and we recycled it again. Treasuries I was looking for moved to 342. We did go to, and the treasuries did go up in 18 toward this target. And then crude oil was, look at crude oil, what it looked like. It was terrible. I'm just trying to find this one chart here, I think, that's out there. Yeah, it might be a different report here. So anyway, I show you that because this, between demographics, and I think I closed down the wrong browser. Yeah, here we go. I'm going to go to the last one. This may be okay, this is where we were at. I was 3 years early, I think. So I'll bring this up. Deglobalization, the final countdown. So this is 2017. And this is where we start taking apart, and that's basically what's happening right now. Finally, there's a war between deglobalization and what's going on. Here it was. So this was the chart I was talking about earlier, 19 trillion 890 at the time, and this whole thing just goes on talking about what was going on as far as the markets. And let me just get back here. All of this was really just talking about really what we were leading up to. I was seeing this starting to happen, but the database kept giving us rotation and going up. Now what we're seeing is we can't get any positive rotation on our intermediate models, and until that happens, we're going to continue to be in the dumps. And I just show you those old reports because that's exactly what we're actually seeing that finally happen. And it's like 5 years early, right? So, but I wasn't the Harry Dent guy pounding it every year. 2017 was the last year we did those reports. And like I said, I kind of miss doing those and writing daily commentary. Yeah, so, and I agree, Patrick Honeycutt, yeah, millennials won't get midlife prosperity. Yeah. Yeah, so, I'm not sure. I can tell you it wasn't much different when I was 36, by the way, and how the demographics and what we had versus, our parents were not better off than we were. They were obsessed at getting us into a point of having a better life. My parents were, okay, you got to get a better life, got to go to college, you got to go to college. We kind of rolled that over, did it again, same kind of scenario. And then really the institutions that we were sending our children to were corrupted as well now. So now you can't even rotate people there. That seems like the right thing to do, but that goes to the whole society being broken down there. Yeah, the good news, Al, is that they are sick with socialism and corruption. But guess what? They've got it now. It's going to break down, and that's what MMT was, right? I went on rants a year ago, especially in 2020, talking about MMT. If you went back and watched some of those live streams I did back in the day, it's been a couple of years now. It's hard to believe, but those are the things that we're really looking at from that standpoint of even though they're there, there's an emergence. It's already awakening. Brandon has helped everybody realize how bad these ideas are, and I think it's going to be interesting. And listen, I'd be honest with you, I don't think the Republicans are better than the Democrats necessarily. I think we've got a uniparty for the most part. There's probably 80% at least is a uniparty. They're all basic beliefs, and even though they may run on different beliefs, they demonstrate something different. And I used to say it was almost impossible to get a senator to be president just because of all of his voting that he's done in the past or lack of that. And the only reason why Obama was in, because he was basically a freshman senator that managed to get to be president. But Joe Biden, I mean, this guy has never been worth a shit since he was been in Congress. So, I mean, I don't know how that happened. So, but the point is that we're at this point where we are. So, couple times, let's see here. We got about an hour and 15 minutes to go. Yeah, I mean, Harry Dent's always anticipating a 50% fall. Sooner or later, it happens. Yeah, David, you're absolutely. I have a much better life than my parents had, you know? Absolutely. So yeah, so they achieved most of their goal, even though, yeah, we've done some good things, you know, um, computers and lots of good things, but overall, it's been kind of a disaster, I think. Now, just looking at some comments here, real quick, folks. Yeah, I don't know if we have to get rid of the political parties necessarily. We just need to get people to step into them. I mean, JFK would be a Republican today. He wouldn't be accepted in his own party. Yeah, Christian, we did cover some stuff. I'm going to go back into the markets here. So we just got into this conversation, which is fine. This is pretty random on this live stream. There's just been a lot of things. Really, what we're talking about is the potential longevity of what's going on in the markets right now, which is they're likely to be under pressure for a while. There's nothing good coming. There's no stimulus. I think they still have the Build Back Broke deal, Build Back Better, is $5.4 trillion. So they want to throw more fire in there. If they get that through, which I don't see that happening, I was talking about that, I don't know, 6-8 months ago. Didn't think that would happen. It hasn't happened. There's no way to get that. Nobody has political capital or anything to get that through. And so if they did, though, we'd end up in hyperinflation, I think, if that happened. So I think the opposite. The Fed's got a hard job as far as figuring out what they're going to do next. What they need to do, they can't do. And somebody asked me earlier that I was talking to is what should they have done? Well, they should have done what they're doing right now almost 2 years ago. Almost when they cranked it up. Let's go a year and a half. So they added liquidity for the COVID crisis. And, you even wonder now what things are coming out, what's real and what's not real there. But the point is that once they pumped that initial money in, it was like almost $4 trillion, then they didn't need more. And that last little tranche, when Biden came in and they put another 1.7, and it was supposedly infrastructure, but social infrastructure, never knew what that was. But I guess maybe we understand more of that now, at least what their perception of what it is. Just looking at the markets here, trading 86, 87. We had a low 49, so we're about 30 handles off the lows there. So, but big numbers out there. I have the 10-year on the chart here right now. Oh boy, got a bot here, folks. Hang on one second, okay? I gotta get logged in. I'll get rid of that guy. Hey Jay, are you still around? I'll kill this one, but watch for him. Okay, I got rid of him, I think. Yeah, just looking at comments here again. No, I'm not recommending staying all cash during the next 18 to 24 months. There will be some opportunities here. Some of this, we'll see a rotation of some sort here. Just looking through. Yeah. Just looking at a couple things. That's pretty funny, Jamie. Okay. Yeah, so we'll go through some stocks here in just a minute. Matter of fact, let's kind of start down a path here. We got a little bit over an hour to go. Yeah, so I just brought up Tesla. We'll do a couple stocks. Let me go through some, and don't give me any suggestions yet, but I'll take a few suggestions from you folks here. Okay, so let's take a look. One of the things I talked about last time I covered Tesla, we had 3 fib targets on the downside, which were projecting 684, which has been exceeded. The next level down, and this was hit earlier, okay? So now we have new projections down, 457 and 329 and 250 on Tesla. So this is a daily number. Let's go over to a weekly just to get a little better picture here for the intermediate trends. Yeah, so we've satisfied the fib target 1 here at 644. The next target's down, which are heading, I got to come on screen because I see this stuff, and I talked about this. I remember going back in the inverse back in 2020 and looking at the airlines, and almost all the airlines looked like they wanted to rise back to their 200-week average, and a lot of them did that. The same thing is happening here on the inverse. Almost everything we look at, the S&P, you just name it. A lot of these stocks we'll go through. I'm going to blaze through a bunch of stocks here in just a minute, but everything looks like it wants to go to the 200-week to the downside. And we're basically just above the 200 on Nasdaq. We're at the 200 in Bitcoin. We're heading toward all of these lower numbers. Minimum is 40-month, which is somewhat equal to the 200 days. So people always wonder why I use the simple moving averages. So, and I don't take the 200, do 150, okay? We do 10, 20, 40, and then you change the length of the chart. So you do daily 10, 20, 40, put a 200 on there, and you do the same sequence on the next time increment or that next time series, which would be weekly. So if you look at it, the 10-week moving average is very similar number to a 40-day moving average. And if you go to monthly, the 10-month moving average is similar to the 40. And when you get to the 200s, they match as well through that time series. And when we were defining Wavetech back in 1980s, we could do exponential averages then. That was no problem. Did have a charting service that was capable of doing all that stuff. We stuck with the simple for two reasons. Is they tended to define the patterns much better. And I know there's good uses for any length. It doesn't matter what your process says. You just need to understand what it is. This is what I've spent, 35 years really. From 1984 is when we started to adopt. PPMs were created in 1984. We did the initial studies, understanding probabilities and probability risk of moving averages holding, not holding. All of that stuff was done way back in 84, 86. And it was a very intense study that we did. And then the first rules for Wavetech and all that stuff was done in 1986. And so those are the first trading rules that were starting to be developed from our trading activity that we did. Everything we did in development, we traded with real money, our real money. So that was all done at that time. So that's why I use those numbers. I use 10, 21, 40, 200. I didn't really use the 200 to about maybe 3 years ago, and I started putting that in. And I built the very bottom of this screen here is the Wavetech 200, which is the PPM for the 200-day moving average. So all the PPMs track each one of the moving averages and start to give you probabilities. I've released a probability map on some videos and understanding the PPMs and utilizing them with the moving averages. So you have to have those probabilities, you have to use my set of moving averages. But they work pretty well, and they're incredibly efficient on things. But just about everything, I'm saying I don't like the global label, but most things are looking to seek their 200-week moving average. I think if we had to start to project where's a potential low of these markets, it's going to be minimum 200-week. And in some cases, I don't want to see us go to the 200, the 200-month. That's really kind of a crazy. Yeah, I don't, Jen Lee, I just saw your comment. Is there any hope for gold? I don't have a lot of hope for gold. I think it's in trouble. Even though so-called, do air quotes, inflation hedge, right? It's not really there. Maybe there'll be something set up. It's holding support, but it's nothing there really to do anything. Yeah, like as I just said, Casey, I don't know. I don't follow 150. Don't have a clue. Yeah, so one of the guys on Halftime had really good advice for everybody. Just control your emotions. Don't let the markets get to you, and it'll get better someday. Unbelievable. Amazing that those people get airtime. Okay, so so Tesla, potentially 200, that's 405. That's a really big number, right? That's like 30% from here, rough numbers. That's a really big number. So I don't know if that's going to happen, but PPMs are trying to stabilize a little bit here, so maybe we stay in a range, but it's pretty much critical there. Like I said, the 2 Fib projections are suggesting that's the case there. I'm going to bring this up here real quick. I just brought up this chart here. This is Trading View with the price projection tool. I'm going to add some indicators in here just so you folks can see what these look like. I'm going to put PPM 1, 2, and 3 on here. And this is those projections on Tesla. I was just talking about. This is daily. So daily has projections right now for 457, 329, 350. Let's click this over to a weekly so we're looking at the same chart. Here's those numbers right now. So we're trading 644 is fib target 1 right now. Last trade, the low was 644 spot on. So see if that number holds. Next level down is 450 and 330. Probably not very realistic. Let me put on, I built an indicator that's got just all the moving averages on it. So this got the 10, 21, 40, and the 200 day, you can see is right there at this level here, which is the low target 330, and SMA 200 is 443. So it's right in that range. So similar scenario, this is Apple. Apple is below, almost to fib target 2, which right now is, let's see what we printed here the other day, 132, 134. The next level down extreme is 126. PPM's minus 2.24, minus 0.88, minus 0.25. So this is the first real looking correction we've seen for a while. But like everything else, that 200 week is just right underneath this action here. So we're definitely looking at the pattern is likely to continue down, even if we bounce. These PPMs and the moving averages have a lot of downward pressure, and this is weekly. It doesn't dissipate much. We go over, might as well go full blown. Here's weekly. This is the number to watch on Apple. That when you see this line through here, this is what we call a pivot. This comes from our price projection tool, and the pivot right now, 128.33. Yeah, 128.33. We print below that, then you're going to the 40-month moving average, which is 109. Yeah, let's go ahead and let's do some of these other. I know coin is getting. We'll go to Microsoft. Similar scenario here. This is the monthly heading to. So look at this. Let's just go here. Look at the fib targets on Microsoft. Fib target 2, 213, 200, 212. So the fib target 1 right now is at 241. We're trading right there. 243 is the low print for today. This is a weekly chart. So we still have PPMs are trying to kind of roll up, but they're still very negative. 1.96. Anything under 0.25 is bearish. So the downward pressure, like when we printed last week, if you would have had the indicators looking at PPM1 at 1.20, the 10-period moving average was 276. The high was 277. You could have been selling Apple all day long against that 10-week moving average last week. So the key level here now, 241. We break through that, 213, 195. So I'm going to stick with the weeklies. That bot is very persistent. Yeah, it was interesting. Let's do some of these other GME. GME actually has some, excuse me, some upward projections here. 200 to 300, which would be very interesting if that popped. This is weekly. Let's go to daily. Daily's kind of negative, not really much there on GME. Guess we'll go AMC. That's always the next one that comes up. Nothing really here. Let me see if I can get this scale just to look a little better here. Yeah, there's just tight ranges here. Down targets on the fib tool is looking at 1221. We're trading 1109, 1071. So 979 would be targets there. And AMC, all negative PPMs, big time negative PPMs there. Let's do coins since we're doing. Yeah, I just want to bring this scaling up just a little bit here, just so you can see this last scale. So this is kind of funny. The fib targets, I've never seen this before. Fib target 1 is, I'm just trying to get this right number here. What do I bring up? Coinbase, okay. Daily. Fib target 1 is 963. Target 2, negative 18. And target 3, 35.91 negative. So those are probably not very likely. But what we're seeing here is pretty negative rolls. Let's go to weekly and see if we can get a little better print here. So weekly is actually acting like it's trying to set up some kind of low here. So maybe that has everything to do with Bitcoin holding the 200. Maybe there's some hope here. Yeah, so PPM, I just brought up the Spider Utilities. That's been a decent player. It's now rolled over. I think Wavetech was selling this out. So we're looking at targets here on the Spider Utilities down for next level down, low target. We're printing below 69 handle, so we're looking at 6680, 6502. Here's a weekly BTU. Upward targets pushing 40, 50. There's some fib targets there. PPM moving averages are fairly strong. PPM 2 right now is positive 2.8. So we're probably going to stay between the 10 and 21 period moving averages right now, which is 24.50, 22.36. Get back above 24.50, could start a run to test some of these highs in here and maybe start a new trend to the upside. Yeah, so here's the semiconductor ETF somebody just asked about. So it doesn't look like there's still quite a bit of downward pressure, minus 5.30, minus 420, minus 179 ppm 1, 2, and 3. They're trying to turn up to their second derivative, so maybe if it stabilizes, you could start to call something. But once again, this is another chart. Not only did we go to the 200, that is, we went through this one. I see somebody going, yeah, Fib 1 is bankruptcy, exactly. Here's a MicroStrategy. Downward, still downward targets here. PPMs are minus 10. This thing's in big trouble. Looks like we get through this level here. The first target. Yeah, here's another one. That targets are negative. So yeah. Let me see if I can get this scaling just a little bit better here. Still lots of downward pressure. All you can hope for is that this thing stabilizes. There's nothing here. Maybe, and this is a lot of these, I don't know what these guys do, but this looks like a lot of the kind of meme stocks, not so much meme, but the growth stocks kind of scenario, where what we're doing is we've done a round turn here. Let's talk about this kind of setup here just real quick. Is that what you get here a lot of times is you get these stocks and all of these IPOs. I'm not sure. Let me look at something here quickly. So yeah, this stock's been around for a long time, so it goes back. It's not necessarily an IPO stock, but a lot of the IPO stocks you get into a hype phase. So these folks got a lot of traction, came in, and we just rolled all the way back from where it came from. And that was something that I was talking about with going back to last year when we started to see the rollover in all the so-called growth stocks, that we'll call them the Cathie Wood stocks. When that started to happen, that was exactly where what they were destined to do. So stocks like this that printed up to 1,315 that are back at 142, they're never going to see these numbers again. And I don't know anything about the company, but survival's probably going to be pretty difficult. And you can look at even stocks like, go back to the .com situation, look back there, and you'll see, like, you know, even the Cisco's of the world that were big time stocks in the .com, once they got blown up, they never got printed back there to any kind of realistic level here. Yeah, no TOS, only on TradingView, unfortunately. And TradeStation took away the App Store. Okay, that makes sense, Raymond. Yeah, all the cheap dollars, all that stuff. Like, let me bring this stock up. This is a classic example, actually. This is a weekly chart of Upstart Holdings. And, this stock went from its hype phase back in when it came out. This is one of the IPO cycles that came out during the pandemic. They got hyped up. I'm talking, basically a lot of millennial traders got on here. There was some guy on the internet that blocked me on Twitter because basically I said, wait a minute, you bought this thing at 90, you watched it go all the way up to 427, and it's back at 200, and you never sold anything. And so I'm buying more at 200. Well, it went to, right now it's $33. This stock is dead. And if nothing else, if it stays alive, maybe it's got a good business model and it can survive as a business. It's not going to be a good investment for a long time. And if it does, it's not going to see that 400 number again there. So. Yeah. Cisco was, I'm just trying to get back far enough here. There you go. This is exactly what I'm talking about here. Here was the high in the .com. $82 down to $8. And this last little run got going pretty good, but even then got up to about 64. This is a viable company. Yeah, so these are the kind of things that happen. This was the big run up, the hype cycle of the .com, the collapse, and then years of just grinding it out, finally getting a little traction, and now it's collapsing again back into the pattern. So yeah, so this is I'll do Boeing. Somebody was asking about Boeing here. I'll just stick with TradingView for right now. There's a big target on Boeing, which is trying to get to this number here, $22. I don't think it's going there, but here's another 200-day, and this is monthly, 200-week rolled through. And if we almost got up to the 200. This goes back to the 2020 video I did, how to beat Warren Buffett, how to take advantage of Warren Buffett's mistake selling the airlines when he did. So this was that rally, almost got to the underside, but look at the 200. It's rolled over, and it's, there's not a lot here for this company. Yeah, and you're probably right, bloodbath. That, it's about Wall Street dumping their shares of Robinhood traders, unfortunately. Yeah, but hey, listen, like I was kind of going off earlier, I really think, just to kind of tie some things together here, folks, is we're looking at, and what we're going to do is I'm going to go on for another 15 minutes, and then the last half hour, we're just going to focus on level 2, what's going on with the with the markets into the close. Okay, so we'll focus back on that. Haven't really been watching the market trade much, but just kind of going through a lot of details. Haven't had a chance for a long time to do this with you folks, so it's been good. Yeah, Brooklyn Trader, I agree. There's no way they're stuck. And like the analogy I used earlier was they're stuck in a burning house, no windows behind them, and the doors across the flames. There's no way out. They have no way out of this thing. And no matter what they do, won't be enough. Even if they convince the market from a sentiment to get a bounce, it's not going to last because reality is going to come back very quickly. And that's even what we saw over the last couple of weeks. I remember folks talking about, and I thought we were going to get like a 3 to 5 day rally. If you go back to my videos, I was talking about if we can get over 42.15, we're probably going to see a 43 handle. We were still grinding it out early last week. It looked like they'd go up to 41.50, pull back into the pattern, and then it was just back, then finally on Friday when the inflation news come out, that was the end of the story, and it just went down. But yeah, so Boeing, not a lot going on. I've been out traveling again, and everything is seems pretty normal, at least the airports that I've been into. So. Yeah, so I did discuss the energy in detail earlier, so maybe on the replay, here comes our favorite bot again. So here's Lockheed Martin. Looks a lot different than Boeing. Looks like it. I'm going to put on here one of our other indicators that you can get. I just want you to see this. And this is probably the most powerful pattern recognition tool I've ever had. Let me just, I'm just trying to get this scaling so you can see what's going on here. So these are the Wavetech webs here. And this is what I call a veil. Let me go full screen. So I call a veil. We came out of what a very tight rope where it ended, and we started to get all these regressions to start to come down. This is probably going to roll down to these fib targets here. Low target 1 is 421. We're trading there. Next level 401, 388 is possible. And this typically will come back to maybe what looks to be like the last consolidation around 370, around 400. That's probably where this one's heading back to. It doesn't look like all the PPMs are negative. This is a weekly that we're looking at. So there's that. Yeah, Troy, I went through, you'll have to re-listen if you came in late. You'll have to come back in and re-listen to that. Hopefully we'll be able to mock this thing up. I was probably that first hour would be worth listening to. So when this thing reposts, then I would go watch that. And I went through a lot of details on the debt spiral and all that. That's where we started this today's stream. So we're 2 hours in right now. So it ended up to be about 2 hours and we'll call it 35 minutes. We're going to go into the close here. And yeah, so that's really Brooklyn Trader. I don't know if you were there, but that's what I'm talking. 4 or 5% would be minimum. We really need to be at 12%. No, they are not. They are linear regressions. They are not a series of moving averages. The only proprietary thing about the webs is the analysis that I've used these since 1990, so quite a few years, and they are really good at recognizing turns. We use them for day trading, those type of things. Yeah, 12. So I wish I let's see here if I can possibly. I'm just looking for something here real quick. I may have found. Yeah, I did find the table. Did I have it? No, I didn't. Apologize. I thought I found it. I was excited. But typically, this was the general thing, and I covered this earlier, is that the interest rate needs to be approximately 2 to 3% above the inflation rate to bring down inflation. And until that happens, inflation is probably not going to go down. And I think, to be honest with you, I think what's happening, the Fed's hoping that we get this rollover and things get better. But when I was talking about the DEF, which is the fuel issue with diesel, if that happens and we get another snafu in shipping, especially taking 20 or 30% of our trucks off the grids, that would be just catastrophic, and inflation probably would spike on that, and there might be even further things that happen from there. So, yeah. So there's a lot of issues. Inflation is not going away for a while, and I suspect there's going to be very, very painful. Yeah, a big recession will bring it. That's exactly what I'm telling you. Is they have to induce that, but they're not going to. They're going to do 0.75. They should probably do a full percentage point. That would be a wake-up call to the markets if that happened. And they should probably do 2% on Wednesday. They're not going to do that. But that's what they should do. And they probably should announce that they're going to do 2% at every meeting. And that would be enough probably to cause some serious demand destruction, especially real estate would just screech to a halt. And I'm not sure how much real estate prices at the moment are going to come down, even if they get into some of that, but we'll see how it's going. Yeah, so I'm just reading some of your comments here. What time we got? About 4 more minutes. I'll just stay here with you folks and talk about a few things and we'll focus in on the close. But I think, like I said, between Japan trying to save the yen and China maybe just dumping securities, since they're not a big fan of Japan, they could destroy this country right now. There's nothing the Fed can do to off that. Are you going to tell sovereign countries they can't sell the bonds? Is that what you're going to do? Is that going to work? Don't think so. They're going to freeze out accounts. So now you freeze, a big piece of the energy complex is frozen because of Russia. And then, you turn off all the spigots here in the U.S. and, nothing's going to get better. Did you kill those, Jay? Are you still out there? I just saw those guys showing up again. Yeah, I'm not sure they are working in tandem. I don't think Bank of Japan is on their own. They're going to support the yen, and they're going to sell and do whatever they want. There's no coordination there. It's not going to happen. They are completely on an island, and China doesn't give a crap about anything. But they could do that. So that's wishful thinking. Yeah, I would say European central banks and those folks, China is not in the group, and Japan needs to save the yen, and everything they do will be fruitful, and nothing will save the yen, because what we're really seeing, as I said earlier, is the end of the BOJ experiment, which was QE back in 1989 and 90 when Japan rolled over. And they've been doing QE for, all these years. It's hard to believe, 30 plus years of QE. So the experiment is done, I believe, and now they have to do whatever they have to do to survive. I don't think that it could be maybe trigger another Asian crisis like we had in 99. And back in the late 90s, that was a problem. And so I don't think that's going to be the case. Yeah, I'm just looking at comments here, folks. Yeah, it would be the end of the post-Cold War world order. Absolutely. Yeah, I know Taiwan is building a plant here in Arizona. And let me put this other chart up here while we're just hanging out. Let's put level 2 up here. New lows on the day while we weren't looking. So here we go. So let's go ahead and start focusing in. It's a good time as any, but they're just hammering this thing down 150, down almost 4% on the S&P. Let's go over to this other screen for just a second here. So Nasdaq down 4.6, Russel down 4.8. The SQ's up 13.78. Bitcoin bounced about just almost 1,000 off the lows, not quite that much. It's coming back in a little bit. Gold's down 50. It's hopeless. Copper down 2%. Let me look at a couple more things on this sheet here real quick. Yeah, I got to put Kathy up here. ARC at $36.53. What a joke. So in April 20, $33 even was the low in April of 2020. And let's see here what the low here, 30. So we almost, we're almost equal on ARC K to the lows of 2020. That tells you everything you need to know right there, folks. Yeah, that was brilliant. That SARC, yeah, that was brilliant to do that. They actually just recently created 2 times long, I think. I think it's called TARK. Let's see here, TARK. There it is. It's down 18% right now, but SARC. There we go. This is, let me create this to, that is weekly. So it hasn't been around much. You can always see it over in the left-hand corner here. But yeah, absolutely brilliant to come up with that. And I don't know if you saw Kathy's comments on that, but it was classic. So yeah, ARC at 36, I have an argument that if it stays under 40 for very long, that they're going to have to close the fund. And I know they keep getting inflows, so maybe there's enough people still buying that thing that is going to be the case. Absolutely, Patrick. Absolutely. You know, so many times I'm on this. It's almost like I'd love to. I know I set up a Discord, and we did Discord originally, and it was okay. And then we have a private room that we got for a trading room, which works really well, and it's very secure. It doesn't have all the quirky stuff that, at least from my opinion, that you have in Discord. But anyway, yeah, we've talked about all this before. Yeah, that's crazy, isn't it? Net positive inflows into ARC. I mean, you know, I think Kathy Wood is crazy. I don't even know. I mean, she's talking about her research team being the best on the planet. And I'm like, okay. Anyway, enough trolling of Kathy. Yeah, I guess you're right. People do think markets only go up. And this is what I was talking about today. If you made it to this far down the road, really what we're looking at here is this is going to be an elongated situation. Nothing's going to happen, but we're going to have to liquidate out of this thing. So let's go back over level 2, and I'm going to go full screen, and we'll just focus on the markets as we come into the end. So we did print a new low here. It bounced a little bit. We went down to 41. The old low was 49, I believe. So new low here. I'll show you some of the stuff that we talk about in the... Yeah, you're probably right, Hitman. So trying to stabilize a little bit down here. But it's going to get interesting coming into close, whether we get any kind of short covering. Yeah, I see, Raymond, you're talking about Kathy has a video called Embrace Volatility. I won't believe, I won't believe if somehow eventually the SEC doesn't wake up and just lock up everybody over there, because she's already broken so many rules from a compliance standpoint. So get a little bounce here. And this is a pattern that we talk about on these webs. You get these rounded bottoms on the one. We got a V bottom here on the 5 minute. This is a 5 here in the middle. On the far right is the 1 minute. And so what we do is we watch for these diamond patterns where you start to get what we call webbing. That's why they're called the webs. You'll see. You'll see how at this, where my cursor is right here, you'll see you get this little webbing that starts to happen, and then you get a move up. This is what we call a 2-point diamond. Sometimes we'll get more. We tried to set up a little web here. So we'll see what kind of pattern we set up. We did spike up here in the pattern, and we're right back in. And this 1 minute chart is already failing here. And one of my favorite setups, actually, and I've started to use this a lot, is this setup here I'm going to show you. This is using all of the indicators that are on that you get. And these are really good because now we have all the fib projections. Right now there's downward fibs for another new low down to 39.28 on the screen here. 1 minute's already failing. Looks like we're retesting the lows. These triangles here are the pivot points that are key to watch for trading. I'm going to put the pivots on over here and just going to enable pivots. There you see them on the right hand side now. So this is the 5 minute and the other charts and the 1 minute. So what I'm going to do here is I'm going to have the level 2 so we can kind of see what's going on with the prints here. So sorry about that. Is we're looking at the level 2. I'm using TradeStation level 2. They don't have that, but you see we get a reversal down. Looks like we're going to try to retest the lows here. We'll see what happens. This is one of the things that are really important to watch, is there's no liquidity in the markets right now. There's literally 10 and 12 on a side. These are ridiculous to try to trade. You get very erratic trading. Looks to me they're going to try to this 41 number. And then what we're looking at is 39.28 is possibility as we're coming into the close. So here we go. See if we can print through the low. So minimum, we look at the downward targets here. 38.28 is the next numbers. So we'll see what happens here. They're testing the lows. We just got some new 1 minute update here right now. We're looking on the 1 minute, 22, 3707, 3698. Fib projections on the downside. So here we go. See if we can break through the lows here. I'm going to move this over just so we can still see, but I want to see the actual time in sales. And what we're looking for here is like red blocks, these big red blocks. Here we go. Here's printing the lows, new low, bounce. The typical algorithm bounce is we will print a new low, we get a 200-point bounce, and they come right back at them again, print another new low, and they keep doing this cycle. So we just did that. We traded up about 150, 200. Here we are, new low again. See if they start to press them a little bit. 41, there's another new low. As long as we don't bounce more than 500, then typically the cycle will continue and keep making new lows. There's a 39 new low. We're looking at, now you see on the 1 minute chart, we're starting to get prints down here for a minimum of 22. It's a big number, but look over the 5 minute right now. Like I said, 38.28 is the number there. So what we watch for is if there's a bounce bigger from 38, it have to bounce to 42, 43. Here's 38 printing. I don't think 5% pre-Fed meeting is normal. Okay, here we go, 38.50. So we printed down to just about to the fib target 2. Next number 28 in the cycle. These bots are relentless here. Yeah, so we printed down to fib target 2 basically. What we'll watch here, I'm going to change the scaling just a little bit so we can see the webbing a little better on this chart. So we're getting crossovers on the 1, which tells us that we're probably going up to the 10 period moving averages, 10, 21, 40 averages here. So we're getting a little bit of a reversal off of that 38 hit. So now we're trading 43. So this is about where the cycle is possibly broken on the new lows. We'll see if they come back at them again. They already are. We'll see how this all sets up here in a second. Here we go. 1 minute just updated. There's something else that we talk a lot about, and I want you to look at where my cursor is moving here right now. This is what we call rope. When the regressions get really tight together, this is an aggressive trend down. So until we start to see crossovers on this 5, we're going to stay in this trend down. We could trade up to the top end of these linear regressions. So 1 minute's trying to get some crossovers. Minor crosses starting to happen on the 5. Here we go. Looks like we may have a bounce, maybe back to the 10 period moving average on the 5 here. That's going to put us back at 56 if that happens. It's got a rejection off the 10 period on the 1. We have right now just under 15 minutes here. They're coming after the lows again, it looks like. There's a potential print to 56 here. We have to print over 49, then we'll print. That's your last resistance point right now, 49. So you can see on the 1 minute over here, the 10 period is just updated. Still quite a bit of downward pressure here. But it looks to me they're going to attempt to print this thing up to probably 54, 56 on the upside here. We'll see what goes on. Alex, I think that goes down, your question, get rid of all stocks now, goes down to the individual stocks need to be looked at. It's a hard general question to answer. Okay, here we go again. Looks like another try at the lows. We are at 12 minutes to go. So they held it again. Here's that 49 print. Probably still looking for a potential. Now we got through the 21 period moving average. You see on the 1 minute, we've got crosses and webbing going on. So it looks like 56 is in the cards here. We're seeing some light algo buying. It's actually mixed, a little light buying on both sides. Buying and selling on the algos. They're not really one side or the other at the moment. Here we go. It looks like they could try them again. We're getting a rejection on the one. Crosses to the downside. I'll try to put a cursor here. You'll see that the regressions are starting to roll down. If they can roll down, then we'll make a new low, and we'll probably print down to that 28 level. So we'll get some heavy liquidation into the close. If you notice on the left-hand side on the level 2, all of a sudden very erratic trading going on. Here we go. Look at this. They're coming in at them right now. There they go. 38.50 printed. There's no liquidity here, folks. If you can see that liquidity meter to the left, there's just nothing there. Here we go, new lows. Probably looking at mass liquidation coming into the close. 36, looking for 28 handle. $35 new lows, 33, 32. Another run coming. Yeah, there's just no liquidity. A couple hundred contracts and move this either way fairly big. We're coming into a critical point where everybody needs to start to execute at the close. Yeah, Kelvin, that's cool. That's exactly what it did. Yeah, there's just so little liquidity here. It should be a wild close here, folks. 8 minutes to go, a little less than 8. 32, 38 prints. So typically we get a bounce like that was a low. The 5 minutes just got that rope. It's just steady down. And here we are back at 45, so we held. $54 is now the resistance point on the 5. It was 56 earlier, so we're getting a bit of a reversal. We'll see if it holds. Down to about 6 minutes to go, 6.5. $54 is the 10-period moving average on the 5 minute. So we traded just below the 38 handle, which was fib target 2. Just went positive on the 5. It looks like we want to print 54 in here. We want to hit that 10. We should get a rejection off of that. We'll see. That's 54.50. There it is, the update. There we are trading right there, 52. I'm going to change something here. Yeah, so now I've got them matched right. This was on June contract, and this is now September, and these are September. So we got through that number. Here's 55, 56. Vertical move here. 4 minutes to go. So maybe some of these shorts are coming out here. So we printed down to, just looking at the number here, down to 35.25 we got to on a quick print. And now we're 20 handles higher. PPM's all turning up on the 5. PPM turned up here on this bar here on the 1. PPM, yeah, right. This bar right here where it was the turning point. Probably see it come back in to probably into 44, 42. So we printed back to 47, then bounced. So there's definitely some buyers. Looked like some short covering coming into the close. We got about 2.5 minutes to go. We'll see if there's any big sellers coming in. Yeah, we'll do a review once the market closes. Oh, everything's settling out. Once this, we've got 1.5 minutes to go. We'll just watch to the close of the cash. So 1 minute and 12 seconds. We're almost in that final minute. Back into 40 handle here. See if we get some heavy liquidation into the close or short covering. $53.50 is the pivot. So if we traded over that, we'd probably see a pretty good rally coming into the close. But it looks to me we are only 30 seconds out from the end of the cash session here. There we go up to that, trying to get to that 53 pivot. There we go. 53.50. They just took it out. So it looks like the answer is short covering into the final few seconds here. 15 seconds to go. Kind of topped out right in, there we go, 55, right in this 50 handle. Moving average is all turning up on the 1 minute and still hanging, having trouble getting above the 5. So here we go, selling into the close. Here it comes. Last few seconds, 47, 46 prints, 45 prints. And that is it. So we are done. All right, let's take a quick review of everything that went on here. And we'll call it quits for the day. So 10-year, 3.36, up 6.65%, up 21 basis points. Pretty big move, to say the least. Bitcoin still holding up. Crude oil only down 0.36, 120. Let's put XLE up just for a second here. Down 5%. So that's a pretty big move. But it's basically, like I said, beginning of the broadcast here, is that they're just selling stocks that raise money, and they're selling stuff that's been working. Yeah, gold down 50 handles. Gold pretty big break on a weekly basis. Everything rolling down. Once again, probably heading 1760, maybe 1700 on gold, heading toward the 200 week. Everything wants to go to 200 week. PPMs are all negative rolls, everything there. So ES still trading around 49. Pretty ugly day, down 387, down 452 on the Nas. The Russel down 478. Just looking at even the just looking at some of these pairs here, just to get a look at them. S&P versus Nasdaq. S&P's been outperforming. So if you were long S&P, short Nasdaq, this is what you'd look like. Here's the same thing with MDY versus short Nasdaq, and Russell's short Nasdaq also some improvement, but best one is S&P. The S&P pair is the best. Yeah, just looking at a couple comments here, and then we'll call it quits. 530 inverted at 12. Yep, absolutely. Here it is. 10.08, and looking at right now, the low was 12 and a quarter, so we're almost at that April inversion low. Like I said, what we have to watch for now is if it stays that way. And if you look at this is interesting, this chart here in the middle is let me bump it over to a weekly. This is the 1030 spread. It is also it's at 0.1, so it's not quite inverted, but it's collapsing. This yield curve has been collapsing. I've been talking about this for better part of 9 months or more. This has been an issue. All right, folks, it was good hanging out with you today. Sorry we haven't done this for a while. We do our live trading room, and the indicators are here. If you get the indicators, you get to come in the live room. We actually moved the live room today over here because this is basically what we're going to do today anyway. There's no way to trade in illiquid markets, and so you're better off not trying to do things, and you can get in trouble if you have any size going at all. And so, but the indicators are awesome. I've used them since 1984. We built the PPMs in 1984, and so 35 years ago. So make sure that you pick up on these things and you get to come into live room for a month. And we're working on a couple other things that we want to do. We're also trying to figure out at some stage when we do get close to a low, it would be very advantageous to have Wavetech or Portfolio Expert. And Kelvin mentioned earlier, because he had Wavetech, he's only down 3%, 4% on the year, and that's because it got him out. And that's part of what we actually do is It's called advance and protect. So when things are going down, you protect your capital. When things are going up, you go long and you participate. And a lot of times we'll call it not only advance and protect, but PPM, participate, protect, and grow. So PPG. And that will get you, that's really what you want to do with your money. And we're going to have a whole series on how to do that. Yeah, hard to say. RK is a disaster. Adobe, Target. Yeah, I mean, none of these. Okay, well, that's probably good, Alex. I mean, I don't think you should have been in any of those. I just looked. If you went through Wavetech, we haven't owned those stocks for a while. We haven't owned any of this stuff. Yeah, so that's why, you know, we always talk about having a process and everything. So if you go to kindlereport.com/Wavetech, you can find out about that, or you can go kindlereport.com/expert, and it's with no E, just an XPERT. Yeah, so, okay, folks, we're going to call it quits. Better part of 3 hours. So awesome being able to hang out with you folks, answer some of your questions, interact with you. I actually really enjoy these sessions a lot. And with this many people, you know, we had probably 1,000, 1,500 people roll through the doors at one stage. So we get some good questions. Most of the time when we're in a smaller room, people seem to be a little tight with their questions. So we'll have to see how everything goes. TNX blow off top. Let's do one thing before I leave. What I'm trying to get through here, if I could stop clicking on the wrong thing. Let's take a quick look at all right, I'm just going to set up another new chart here. Let's do we'll set up a new graph very quickly here. All right, we're going to put this up here real quick and get rid of, I'm going to set up a quick, I want to put up, this is just a 5 minute, so we're going to go daily. And where do we end up here? Over 134. So in spite of the BOJ coming in, that absolutely accomplished nothing. If they come in for another round of selling, it's going to push the treasuries up, yields up even more, bond prices down. So we're just not going to get out of the woods anytime soon here. So just know that this is the thing to watch here. So make sure you watch this. Yeah, there could be budget. This is not. This is not going to end well, and this is the beginning of something. And like I said, what we're seeing is the end of the Japanese experiment, or the BOJ, Bank of Japan experiment, with 30 years of QE. Game over. Looks like now that they have to defend the yen, they're going to have to sell off a lot of their treasuries. That's their high yield. and they're buying JGBs, which are Japanese bonds. So they're trying to offset this, and it didn't do much. It flattened the market out. It was a little bit, the yen was a little higher, and it just finished slight lower. But this is the market to watch, folks. This is what's going to push yields, and this is going to keep pressure on all the other markets. Listen, I will see you tonight. So have a great evening. I'll see you at 9:30 tonight. Hopefully I'll come up with some more insights. It was great hanging out. We'll talk to you soon, folks. See ya. Don't forget to hit the like button.